Good evening and welcome to this very special episode on Money Control, the Diwali Muhurat Roundtable. I'm Mahalakshmi and I have with me 6 brilliant stock market investors to help us navigate this year. Sameer Arora, Devina Mehra, Manish Chokani, Sunil Singhania, Madhusudan Kela and Prashant Jain. Thank you so much, gentlemen and the lady, for joining me on this discussion today. Let me ask this question that is really on everybody's mind today. This year, till date, if we see, in rupee terms, the Nifty has gone nowhere. It's pretty much flat. But in dollar terms, if we see, we are down about 12-13%. And in the US, if you saw the numbers about a week back, US was down more than 30%. So, and because of our past experiences from 2000 and 2008, we continue to believe that markets are not decoupled. But a 12% down versus a 30% down is already very divergent. So my question is, the fear that we live in, the fact that we cannot be sanguine if the US markets are not settled, is this fear really legitimate or is it unfounded? So, Manish?
Wow, that's a great question to open with. The way I think of it is, Mahalakshmi, it's true that you can't be divorced from what's happening in the world. And it's also true that in 2008 we saw how whatever happens in the US and the developed world comes and affects us. But I do think there's a variation to it now, that we lived in a unipolar world after the fall of the Berlin Wall, and it was a one direction bull market for bonds as interest rates kept falling. It was a one-way directional bull market for equities as again rates were low and multiples kept going up, and the US became the center of really the universe. But with what's now going on with China, Russia, Saudi, world is breaking into a more multipolar world, and therefore the decoupling is in progress, where globalization is, in a way, it's over. And you're looking for resilience in supply chains rather than just in time and so on. So we are part of that theme. We are not the makers of that. We only can follow the themes which are happening in the world. And the emergence of, for example, the retail investor, which these gentlemen will be better placed to talk about, has made the case that you don't necessarily have to fall or rise in line with the leader of the world. Very similar to stock markets, right? When the IT sector fell in 2000, someone else took up the leadership. When FMCG fell in the era prior to that, someone else took up the leadership. And the same thing will happen as well. And mankind goes on.
Sure. Devina, you want to comment on this?
Okay, I mean, see, this decoupling is a strange word because you are neither at one extreme ever nor the other. So you are affected by global trends, what is happening in the globe. But there are also broad long-term trends. So if you go back last year on your show, I had said two things. One, that rupee depreciation is almost certain to happen. And two, that India will outperform. And there were two reasons for India to outperform, which were that relative to its own history, it had underperformed a long time. So 2010 to 20, you had not even beaten fixed deposit returns. And the other was that even globally, you had been underperforming a long time. And 2021 was the first year where you started to outperform. So this year, as you rightly said, global markets are down as of September end. Calendar year to date, global markets were on the average down 25.5%. S&P was close to that. And we were down, but we were number 8 out of 42 indices, because there were only 4 or 5 indices which were actually in the green. So that's the context. But I mean, I also think, many times we make stories of why something is happening. If you go back to 2003 to 2007, also emerging markets outperformed hugely. US, in spite of coming out of a very big fall after that dot-com burst, in those 5 years went up only 60%, did not take out its previous highs, whereas the emerging market index went up 3.5 times, India went up 6 times, Brazil went up 10 times, etc., etc. And at that time also the story was that now US is over and the next century belongs to emerging markets. Then there was this whole decade 2010 to 20 where the dollar strengthened, US markets did very well. So the stories always follow. But fundamentally, yes, and also in relative to the history, we are not above the trend line. So possibility of a big crash is, I don't see that. I see the outperformance relative to the globe continuing. But as again, there is not a one-to-one correlation between the economy and the stock market, either in the US, globally, or here. So those are two different things. But I suppose we'll be talking about that more going forward.
Yep. So I wanted specifically, Sameer, you, because you've been talking about this quite a bit all of this year, that we should be fearful of what happens in the US. No quarrel about that. But would you expect such a divergence, which makes us question if at all there is such a strong correlation as we usually believe?
So first thing is decoupling. I guess you mean that if one market is down, the other should be up. That is quite tough to do. But if you look at it over time, these things decouple or go their own way. So for example, every year, if we say that we are looking at the US market or overnight factors, but if you look at it over 20 and 25 years, India has outperformed most of the other markets by, like China, it has outperformed by 11% per annum for 25 years. And if you look at it for 30 years, there was a report from, I think, Bank of America, Merrill Lynch, that India is up some 7.5% per annum. And most of the other markets are up 1 to 3% per annum, whereas only US was up some 8%. So I would say that I learned from it that I don't overbet that if we are doing well in the absence of US and generally the globe being happy, that becomes a tough thing. So relative outperformance is as valuable, I think, if you look at compounding. How does compounding work? It means that if in bad days you can lose less and in good days make as much or a little less or more, the compounding of that is more valuable than losing a lot when the market is down. So this year, I think India has done tremendously well in any slightly longer term compounding potential.
Sure. I'll want to ask more specifically on where do we head? I mean, what kind of divergence should we see over the next 1 year? But before that, one more macro question. And all of this year, as all of last year, actually, as the markets climbed newer highs, the main headline was that we are moving up in terms of rank, in terms of GDP, right? So if you look at nominal GDP, we are number 6 in the world. In terms of market cap, we are number 4 in the world. But if you look at the per capita, we are number 145 in terms of, I think, nominal per capita, and probably 125 in terms of PPP. Does this worry you, Madhu? Because, you and Sunil, for sure, of course, everybody, also take heavy bets on consumption. And one of the big stories in India is how we can continue to grow on the back of our demographics, on the back of all the, domestic engines firing. But this number, such a divergence in terms of macro numbers versus per capita, does that worry you?
Mahalakshmi, that is very logical, isn't it? When you are operating at such a large population bet and you are comparing yourself to countries which are maybe 1/20th of your size in terms of population, obviously your per capita income will be lower only. So in absolute term, it doesn't worry me, because that is the potential which you see, that if you have to go, we came from $300 billion to $3 trillion in last 30 years, right? If I take a next 30-year bet, if we can go from 3 trillion to 30 trillion over the years, obviously our per capita will also go up in the time frame. To the extent it has impact on the stock picking, that is fine. But it's not in absolute term. I'm not worried because our per capita is lower, so there are no opportunities here.
Sunil, essentially the question is, I mean, this whole theory that we are on self-propulsion and we can drive our own growth. When you look at it from the perspective of per capita, does it worry you?
So, I think, Mahalakshmi, yes, we are low in terms of per capita compared to where the other developed world are, but we also have to see where we have come to. So from having maybe 75% of the population who could afford nothing, we have at least gone down to at least 60% of the population who is able to afford quite a few things. And as we move forward, more and more of the population will come into that bracket where they would be consumers themselves. So, if you again go back and see the other countries on a per capita basis, maybe we are $2,000, but on purchasing power parity, we are maybe $7,000. And we are right there in terms of tipping point. If you see the example of China or Korea or even some of the other countries. And it is also getting reflected in the size of some of our own companies and sectors, where the companies and sectors were 10 years back and where they are today. I think almost all the consumption sectors are at least 10x of where they were 10 years back. And there is no reason to believe that in the next 10 years, the similar kind of growth would be there in terms of the demand for all of them. So I think, yes, the per capita is low in terms of or relative terms, but that is an opportunity. We are only going to go up. And I think there is no doubt that this $2,000 would, become $10,000 in a matter of maybe 15, 20 years. And I think that is what we are all paying for, right?
Sure. Prashant?
Just to give some context, unlike in developed world where you may have a bell-shaped consumption curve and therefore you see there's a big middle class, the India demand curve is a vertical line. And I'm just using rough numbers, okay, don't hold me. But you may sell 3 million cars, but you may sell 6 million air conditioners, which is double. Then you sell 12 million refrigerators, which is again double. Then you sell 24 million two-wheelers, which is again double. Now, and so on. You go to cellular phones, you'll be at 48 million and so on. So there's a doubling of markets at different price points. But all these people actually do want to consume. And it's a matter of time as you keep coming into that per capita level, as they were rightly pointing out, that you get to that consumption. To use again a very stark example, and all these gentlemen have worked in the fund management industry. Did you imagine in India that I think SBI mutual fund, is it now close to $100 billion AUM? Like when I started my career, we used to think, my God, Capital International, $90 billion fund, it's so big, it was something we could not conceive of.
Yeah.
Today, that industry is the one which is supporting the Indian markets, even when the FII sold $30 billion last year. So the power of what can happen in a large domestic economy will play out, and there are therefore these different layers and levels at which different stocks will keep performing. And it could be a 20, 30-year story, as they are rightly pointing out.
Sure. Prashant, this whole consumption theme, at a macro level, do you see it playing out? Of course, like Manish said, even if markets are flat, a lot of fund managers like you, definitely all of you will outperform because you're great bottom-up stock pickers. But overall, do you see the stark contrast in per capita being a stumbling block to consumption growth?
No, Mahalakshmi, in fact, that is the opportunity. And because see your real GDP in India for last 40 years, we have grown at 6 to 8%, and now population growth in India has declined. We are growing barely above 1% now. So that means if your real GDP is 7%, 6% is the real increase in per capita income. And that is the real opportunity. So as affordability goes up, and that is what is driving growth in India, demographics and low penetration. So I don't worry about that at all. That is precisely the opportunity for growth in India.
Sure. Manish, coming back to global markets, I mean, what are the big risks that you see going into this year, especially on the geopolitical front?
Well, for India, it's oil all the time. If it goes to 120, because our external balance sheet is very vulnerable. Unfortunately, we've not solved the energy problem in India for 30 years with exploration blocks being given out. Nor have we built a big tourism inflow. We are very vulnerable to remittances. So that external balance sheet is a vulnerability for us, and which is what I guess all shocks in India eventually emanate from outside, and markets always suffer when there's leverage. Every crisis I know in the world has been caused by leverage, including what is happening in the world now. You will get the war and you'll get the COVID, but we quickly rebound from those. But these are structural, longer term issues to think about. But I'll pass to my other colleagues.
Yeah, I have a related question to this oil thing. One of the big shifts that has happened over the last year or so, is this year actually, because of this Russia-Ukraine thing, is that our energy basket, now 20%, nearly I think 18% of our oil comes from Russia, and there you are able to do it in rubles as opposed to the dollar. So if this sort of trend continues, if we are able to build on that, do you think the vulnerability that we have to oil today and to the dollar, is that going to stand diminished? Will that be substantial enough, Madhu?
I think it will be a longer term trend. I don't think that, this Russian thing, because the distance is still very high.
Yeah.
How much crude can you actually bring from there, and what is the discount can you get? Let's say today you may get any discount, but on a long term sustainable basis, those discounts will not, I don't think that is the solution. You have to definitely do more in India, more exploration, or we have to deepen our sources, like what is being done, a small step on the ethanol industry, for instance. That is real solving many problems together. You solve the problem of the farmer by giving them better prices, you solve the problem of clean energy, you encourage domestic production. So things like them which can make us more energy dependent. I would just like to respond to the question which you asked Manish, what could go wrong? See, in my mind, apart from oil, if there is any major global conflict which were to happen, any big geopolitical thing, see, till now India has very nicely taken a neutral position, right? And we are neither here nor there, so we are friends with everyone. But if there were a real major conflict which happens, and if you have to take side with one or the other, which you will have to in case of a larger conflict, that is a real big worry from a market perspective, because certainly markets are not discounting that, neither global markets not. There is a lot of fear, a lot is being spoken, but no major conflict in the world is discounted by markets, according to me.
Sure. So Manish, oil, Madhu, major conflict, Prashant?
I think oil is a worry, and I don't think ruble will solve the problem, because it does not fundamentally alter your inflow outflow situation, because rubles also you need to earn them. So which means what you are importing, so it is just an accounting issue. I don't think it changes anything. I think what I would worry about apart from oil is the US interest rates, because US interest rates I think had few tailwinds in the last 2 decades. One was continuously declining export prices out of China. Now the working age population in China is degrowing for last 4 or 5 years. Chinese wages are going up. So I think that tailwind of lower export prices out of China is not there. US interest rates are going up. Mortgage yields in US will need to keep pace with that. Therefore, rents in US will have to go up. And the working age population growth in US itself is now declining close to 0 for a variety of reasons. And US, therefore, all the 3 sectors, the import of goods, the rents which have a 20% weightage, and services, all 3 I think face structurally higher inflation. And therefore, I feel that the inflation rates in US will take probably an economic slowdown to come down, and therefore, the cost of capital in US may actually settle higher. And it would not be catastrophic for India, because if you go back to 2005 pre-Lehman, we were pretty much in the current zone of cost of capital, but it does make us vulnerable to any disruption in capital flows. I think if the world slows down, oil prices should logically come down and capital flows could also get impacted. So they may offset each other, but if you have a fall in capital flows and oil going up, it could be quite challenging for India.
Correct. Sunil, what would you peg as the biggest risk to markets, primarily from external factors?
So, if you go back, see the last 15, 20 years, the risks which are visible and which we all talk about, actually when they happen, the markets don't get impacted as much. So, with due respect, whatever risks have been talked about, I think all of us have, micro-analyzed a lot, including oil, inflation, global factors, currency, and so on and so forth. But what has hit us has been risks which we have not even thought about. So Russia and Ukraine hit us when we were least expecting it. COVID hit us when we were least expecting it. So frankly, whatever risks we all know, I'm not frankly too much worried about it. It is the risk which we are not discounting, which can be like a Six Sigma event, which someone alluded that if the crisis as far as conflict is concerned really gets out of hand, So some of these risks which are not discounted, I think, are the risks which I am worried about. Oil, my medium to long-term view is very bearish. I think whether OPEC reduces production or not doesn't matter. The way every country is now looking at alternatives because they know that they have been really, really squeezed in this, Russia-led gas squeeze. And the way renewables and alternatives are being sort of sought after and billions going there. Medium to long term, my view on oil is very negative. Near term, it might go up and down, fight in dollars. But I think it's a bigger conflict or something which we have not even thought about is what we should be worried about. I think all these inflation and all is more than discounted.
Devina, do you think oil, terminal interest rates in the US, these are discounted in the market right now?
Okay, see, I mean, as I told you that the economy and the stock market, as we all know, are two distinct animals. So even if you look at the US itself, yes, I mean, I am fairly certain that further slowdown, recession, whatever would come, interest rates would continue to go up. But the question is how much of it is already in the price? If you look at the US itself, in 50 years, this has been only the fourth time that S&P has been negative all 3 quarters. In the first 3 quarters, only the fourth time in 50 years. If you look at bond and stock prices both being down significantly in the US, it is the third time in a century, including 1931. So, I mean, the question in all this is that how much of it is already discounted in the price, and probability wise, the global markets, at least, I mean, I'm not talking Europe just now, I'm talking more the US and a few others, like Canada and all that. Is it already in the price? Probably yes. If you look at India, to my mind, I mean, you talked about that domestic consumption story. Again, this is not necessarily about the stock market, but if you look at the economy as a whole, it is not just that our per capita is lower. The fact is that we have not crossed our 2019 per capita till now this year. And it is showing in all sorts of things. How many people want Nariga jobs, how many people want free rations. There's a lot of distress still in the economy. Your mobile penetration has gone down, actually come down in percentage terms. Two-wheeler sales last year were the lowest in 10 years. I think I spoke about it last year also. This year, of course, they have gone up from there. So all these indicators also last 2-3 quarters, there has been improvement. But we have a major issue. We also have a major issue on our so-called demographic dividend, because if you look at how a demographic dividend plays out, there are 3 components to it. Number of people in working age, the labor participation rate, how many of them are actually working, and then the productivity. So we have the first one, which we have for, I mean, again, a limited number of years. But we are not able to generate jobs. Even pre-COVID, we were at 40-year unemployment high. So those are the things that worry me on a longer term. On a medium term, probably not, also because there has been a movement towards more formalization of the economy, more things moving to the organized sector, which means, of course, more things moving to the listed space, which in any case, many times is catering to the relatively well-off. If you look at, for example, listed real estate companies, the client they cater to are the relatively well-off, and that part has done well. Basically, organized sector employees have done well in the last few years, but the rest of the economy is hurting. But as I said, economy and stock market are 2 different things. So, my view on the stock market remains more sanguine. And in the US, again, I think a lot of it is already in the price. I mean, the nuclear tactical weapon, which is talked about occasionally, whether Putin will go and drop a nuclear device in Ukraine, I don't think the probability is very high. I mean, I am no geopolitical expert, but my real worry is that even if he does it and it becomes something that is accepted by the world. I mean, France has already said that they don't really care, even if, I mean, at least they're not going to act even if Russia does something like that. And that, if it becomes something that is acceptable to the world, that would be a worry for me. more than the direct fallout. So, I mean, my medium to long-term worries for India are more to do with what we do with ourselves rather than so much of an external shock. Yes, a vulnerability to energy and oil remains, but I don't see an immediate problem there
Thank you.
beyond what has already happened.
Sure. Thank you so much, Devina, for articulating that point. I should have articulated it better. It's not just a per capita consumption worry, but also the destruction that has happened post-COVID, and we keep talking about it all the time, the K-shaped recovery and so on. So thanks for bringing that up. Samir, back to you. One, on the geopolitical front, external risks, do you think all of it is really priced in?
So I don't want to answer your question. I'll comment on the other fellows because I was thinking of what I would say. So I totally agree with Devina that there is really not so much of connection between economy and market as you're trying to make. Because simply look at the last 25 years, the best economy in terms of growth, in terms of per capita improvement and all was China, and the market is up 1% per annum. If you say per capita, look at the per capita growth, then look at the performance of Korea and Taiwan, much less than India. So these things don't matter. I also don't believe even reforms matter so much because many of the reforms actually help the economy but don't help the market. Let us say today we say that the Indian government has allowed FDI in 20 sectors and people can come in with no approval or easy approval. That helps the economy, helps create jobs, but it puts competition against our listed companies that may be slightly protected because it is more difficult to get in. So these things are not one-to-one in any way. But I agree with Devina, and maybe your second question is answered, that the US market, I don't think the inflation problem will go away, or at least it won't go back to the 2% kind number that the Federal Reserve may today be targeting. I think they'll accept a slightly higher number simply because there are two big picture trends. One is anti-globalization, only you could call it, which was that you are not, or you could call it that people want to have a second China plus one, or they want to be near shore, or they want to make chips in their own country, or that they consider China as a competitor now more than just a developing economy, which they are trying to also help. And second is the cost of dealing with the climate and all these alternatives, which may all be very good in the long term, but the amount of money required is too big, and that cost somebody has to bear. But from a market point of view, I think the US market plus minus 2-3 months as these events play out, and then there is a pause because I don't think they will increase it beyond the next 3 meetings, which is November, December, and Jan. Then plus minus that, I think the market will at least stop falling every day, or at least we'll stop thinking that it can fall every day. And then our markets can do well. But let's not link every line to a 10, 20-year economic growth for India, because last 25 years, Indian market is already nearly the best market in the world. If we can get that year by year, that is enough. We don't have to harder sell it to say that the reason for investing in equity is because this is the golden time. The thing is that normally equity markets do well. Indian markets have done well in the past, and there is absolutely no reason why they should not do as well. But it's not otherwise something where, you sell it so hard that people have to sell their houses to buy equities. It anyway is easy to convince yourself that equity is good. It has been in the past for India, and it will be at least similar or maybe a little higher. But there's no need. If it comes more than that, we'll all take it with both hands. But I don't think just straight GDP growth matters. Otherwise, it would matter in all these places. US GDP growth is 2.5% per annum for 25 years. Their dollar return is 8% per annum. Equity markets need their, as Devina was saying, this unorganized to organized. Which sectors are they really targeting? Which I think in India's case, we mostly target the 300 million, 400 million population for nearly all listed companies. It's a great story.
Sure. Samir, since you brought in, emerging markets and other markets, one of the things that you have also been saying all of last year is, at least last year, up until last year, we had this feeling that India had just, arrived and foreign investors have discovered India. Now it's looked at as a separate asset class because of the amount of money and the kind of size of bets that, that India has become. Even now it's double the MSCI weight, right, India. But this year till date, if we see, that entire flow that we got last year has got reversed. Instead of us, that entire flow went into Brazil. And I remember Prashant saying this last year when, all of us were thinking that flows, if it continues, it will continue for India also. He was the one who said, I see FI as going to China because they are extremely underweight on China and therefore money could flow there and we could get affected. And that has really played out this year. Now, so I come to you, Prashant. What is your take this year? Next 1 year, now that foreign money has already flown into China. Second was Brazil, which pretty much occupied our space that we had in the past year. And we are like humongously negative. So next year, does this reverse again?
So Mahalakshmi, maybe I was right just by chance. I mean, I had no great insights, but see, these flows are extremely hard to forecast, but the great news in India is that equities have moved from a peripheral asset class to a center of the place asset class for households, and India's pool of household savings is very large. Just financial savings is $300 billion a year. So I think the volatility that we have seen in the past, and we were talking about decoupling, so our economies have never really been coupled materially. It was only in crisis situations that stock markets had short term coupling, and I think even that will probably reduce now, because you have seen, as Manish was saying, 30 billion of selling and markets have done well. Maybe this pace of flows may not sustain locally, because unlike last 2 years where bank deposit rates were extremely low, now I think we are moving into a situation where bank deposit rates could move up sharply. But still I think the flow of local savings should be significant, and the volatility that we have seen in the past relating to FI outflows may not be there to that extent. But what happens to FI flows, I really have no crystal ball. But on one hand, you could be faced with US interest rates going up, which is negative for EMs in general. On the other hand, I think India is indeed emerging as a standalone core asset class. I mean, it is the 5th largest economy in the world, it is the 4th largest market, and more importantly, it is the fastest growing economy by far in the world. I mean, look at what is happening to China, look at their growth rates, look at our growth rates. So, the gap between India's and world GDP growth rates, I think is extremely healthy and sustainable. So, I would not worry too much about that.
Okay.
Mahalakshmi, if I can just come in this FI flow, you also word the word humongous, but when you look at all of this in the context with $650 billion of total FI inflow, out of which we have seen outflows of $35 billion roughly from secondary market. They have pumped in something like $15–20 billion in the primary market already. So what we have seen is only 2% outflow on the base, on a net basis. So by any stretch of imagination, it can't be like, it's not a big deal per se. The other reason why the money went out for good reasons, because Russia collapsed, China collapsed, emerging market in general collapsed. So India's weightage has actually gone up, and the people who are following the weightage system of investing money, and most large institutions follow it. So the selling came because our weightage went up disproportionately higher because of the other economies doing well. So I don't think that we should make any.
How do you see this year? Do we, because some kind of offsetting over the last 3 years has happened. So do we see?
One thing which I clearly see, I don't know this year or 6 months or 2 years, they have no option but to invest money in India. I don't think that we can live with the fastest and the best growing economy and we can remain underinvested. Now the question is which kind of money will come. The money could come from family offices, it could come from FIIs, it could come from institutions, but I think money will come. Now the moot point is, when they sold, it got absorbed by the local. When they come to buy $50 billion, what happens to the market?
Sure, fair enough.
I'll just add, we focus a lot on only FII flow in secondary market. There is a larger flow in private equity.
Right.
And even larger flow now in FDI. And like we spoke earlier about the geopolitical changes which are taking place, I don't think 2 years ago you could have dreamt that Apple will launch iPhone 14 and say make in India. So it's clear that the world in their mind has made up its mind that India is a friendly shore. We can put up capacities over here to replace what we had done for 30 years in China. If provided we do all the right things, I think there is a manufacturing renaissance waiting to happen. I've sat on PE and I've sat in companies. For example, the European energy costs are so high and they were also so dependent on China that chemical industry will shut down over there, and the entire industry has to move. Today the profit pool of Indian chemical industry excluding petchem is $4 billion, which is nothing in the context of the world. Just as an example, the shock we got to our system on saying I can't get defense equipment in a crisis has spurred us to say we have to start manufacturing ourselves. Other countries will also want to start then getting stuff produced from India for themselves. So the space which has opened up for FDI and private equity is, I think, far, far greater than what is going to come from the FII side. Thirdly, for us to believe at $3 trillion in a $100 trillion world market cap, we are a separate asset class. Sorry, not yet. We will get there, but first will be FDI, then private equity, and only then most guys, and I include all of us in that, are followers of trend lines and momentum. If the market does well, forget 50, 75 billion can come. If the market does badly, 50 can go out. So
the cost effect is actually reverse, you're saying. The market goes up,
like
the
last year
money
what he
comes in, the
said, they could not sell China and they could not sell Russia. So you sell where you are able to, which was India.
Yeah,
and they sold financials because that's what they held.
Russia, the whole thing was frozen. That, and it was a big, it was a big weightage in the overall index. It was a big weightage.
Correct, fair enough. Samir, you wanted to say something.
Yeah, I was saying that this FIIs, why are you worrying about FIIs? First of all, they would have, in just the 2 years of COVID and after that, would have made at least $150 billion or $120 billion if you take, say, they made 50% on the 300 odd billion, that 400 that they might have had at that time. So now they are at 600 odd. So the second thing is the FII and the private equity guys coming from the same pool. It's not coming from different pools. The pool is of these 4-5 endowments or sovereign funds or family offices. It's not that there is some fifth category of PE guys. So in the fact that they put 60 billion last year into private equity and maybe only 5-10 billion in FII, that's 5-10 billion. See, the thing is, let's be practical. What do we need now? They have been selling $30 billion or they have sold $30 billion. If next year they say we only will buy $2 billion, we'll be very happy because then the Indians can take it over. Right now, the thing has been that we have had to absorb as Indian investors 30 billion of selling. You need 5 billion. Story over for the market. And we are only talking about the market here. Economy, if you want to talk separately, have a different panel discussion. The point is, it's this thing, and also look at it big picture. For 25 years, FI flows have been positive for, I think, 21 years. How did we get to this 600 billion when broadly every year, maximum I think we may have got is 20-30 billion, is because they've been putting in forever. Therefore, suddenly it's not going to stop because this year they have redeemed. By the way, they've sold 45 billion from Taiwan and more than 30 from Korea this year. And by the way, when people say they are putting money in China, let's be sympathetic to them and send them to psychologists, because it's just a case of Stockholm syndrome. That these guys have been stuck and over bullish and carrying that flag, and they've made zero money for 10-20 years. So they are not able to walk away. But slowly some of them who are smarter will walk away or at least reduce.
Fair enough. But finally, the point is that the money went there, it didn't come here. So that's something we should worry about, right?
No,
Yeah,
it's one
on
loss.
they
It's
went
just
to
what the
Brazil.
future money.
Let them lose money. That's a different story altogether. Okay, okay, fair enough. Sunil, on the moving to the domestic flows, I saw a slide that Manish shared before this discussion, where the time series was the MF money and the DII money, and I see that the DII money is fairly inconsistent. Year wise, if you see. MFs have been fairly consistent, but still at a as late as 2019 and 2016, you had about $7 billion. Today, this year was at $21 billion. So there is still a huge gap, and it's because of this $21 billion that we have been able to sustain the markets at the levels that we have. So now, is that again, what is the cost effect there? Is it a function of good markets, meaning more money, steady flows that becomes a counterbalance, or can that really be taken for granted that irrespective of markets, this is now sticky money that can remain?
So again, if you see the history of the Indian investor, and we've worked a long time in mutual funds. 20 years back, the concept of systematic investment plan did not exist, and that time what you said was right. In good times, everyone used to come to the markets. At the slightest hint of a correction, they used to just exit lock, stock and barrel. I think that has changed now. On a monthly basis, we have SIP flows of $2 billion, and they have been very sticky. Even during COVID times, there was hardly any, reduction, maybe a small reduction here and there. But they have been very, very sticky. I think it's the HNI flows which tends to be a little bit more volatile. But hats off to the Indian retail investors. They have understood this concept of investing regularly and having confidence in the Indian economy. And I think this $25 billion a year looks very, very sticky. On top of it, you have the pension flows, which again, on an average are $1 to $1.5 billion a month. And I think that makes this pool of money really, really sticky. Obviously, the large family offices and the HNIs do take some call on the markets. But again, I think if you see from their perspective, everyone has understood that ultimately over a period of time, it is equity, which is the only way you can generate wealth and outperform all other asset classes. And I think this whole concept of professionally managing money, it's really, really become big over the last 5-7 years. So a lot of families have wealth, and there are so many families who are now wealthy. Instead of just putting money in land and putting money here and there, I think they are now very systematically investing in equity markets. They might take some tactical call here and there, but ultimately majority of their wealth is going to be invested in this country by way of either private equity or public markets, but it is going to come into equity markets. And I think that gives us a lot of ability to grow as an economy at maybe 6-7% or higher without too much of FII flows. And in fact, if FII flows come, which at least I believe will come with a vengeance, then this growth rate of 6.5-7% can inch up to 8%, because all said and done, I think if there is capital flow and there is capital formation, it definitely adds GDP. So from a domestic perspective, absolutely no doubt that this flow is going to continue. And, if the foreigners return, which they will, I think then it will just be a catalyst to the economy rising even further.
Fair enough. Anyone who disagrees with this, I mean, the HNI money being not sticky, and will that make a dent at all?
Mahalakshmi, if you look at the retail ownership of India, it is going up. The direct retail ownership, it is steadily going up, and I think we had computed this number. It was almost, I think, 5,000 crores a month is direct retail ownership. So I think retail flows are here to stay, but the extent of it, I think only time can answer, because one big change that is happening from 2 years back. 2 years back, retail ownership was extremely low, and please remember what happened in the COVID year. Locals were massive sellers. Yeah. So the equity ownership base was extremely low, which is not the case now. Almost 20% of household financial savings flow has gone into equities, which is quite a reasonable number. Second is, in COVID times, the bank deposit rates were extremely low. and now you are at a level where credit growth is outpacing deposit growth by almost 7%. So, whatever excess liquidity is there with the banks is disappearing. So, bank deposit rates have to go up sharply, and the moment bank deposit rates start touching 8-9%, and along with that last 1 year, 18 months, no money has been made. So, I think let time answer this, that how does the retail flow behave in this environment. But I do agree with Sunil that equities have moved from a seasonal asset class to a aseasonal asset class, but the extent of flows, I do not think one can accurately take a view on that right now.
Fair enough. So, just moving on to sectors and stocks. So, we'll just hit the bets part. So, should we start with Samir?
I don't talk about bets because my whole philosophy is that I have 15, 20 new kind of stocks, new listings or old stocks which have fallen a lot or something happened. And I have 2.5% each in 20 stocks for 50%. And some of them will do very well, but I won't know exactly which ones will do well at what time. For example, how would I have known at the end of last year that suddenly this year some Varun beverage will go up 80% or some lemon tree will go up 80%? You don't know. I just played as a pool, and that statistically has worked for me forever.
Last year, you did agree to financials, Samir, and the other bet was, of course, broadly. Yeah.
Oh, sorry, it's not sectors. Yeah, sure. So sectors are mostly
and
for
or
us.
Teams, whatever it is.
Yeah.
Plus your
So
bet on
broadly speaking-
fintechs. Plus your bet on fintechs. Not to
Fintechs
forget.
worked last time. I said that 50% will disappear. I don't know how many. But I'm saying in general, if you talk about sectors, then it's mostly always financials, consumer, and IT, pharma, specialty chemical, which we call as exporter theme. But currently, I have zero in IT for the first time in 27, 26 years. But otherwise, I have financials in consumer and a little bit of pharma and specialty chemicals. But generally, otherwise, big picture, we always like these three themes: private sector financials, consumer, and this exporter theme.
That is your overall strategy anyway. I mean, those are the three buckets that you do because you don't.
You said what are my sectors, so I'm telling you my sectors.
For this year, any specific?
No, they don't change. Oh, see, this year, if you say relatively, then as I said, I have basically reduced IT to zero, at least for the first 5-6 months, I would think. I mean, from here, 5-7 months. And then we see how it goes. Because even if everything is good, I still have to choose. It's not that, oh, is IT bad? No, it may not be bad, but I have to bet whether it will outperform my other sectors or not. And in consumer, my stocks are mostly those which I hope will grow at 20% plus and not this 10-15% plus. And they are basically catering to low ticket consumer, if I call them, which is that they are for the middle class, leave out the first 50 lakh people and leave out the bottom 70%. But for the rest, it should be some value for money and reasonable ticket, as I'll call it.
Fair enough. Just spending couple of minutes on IT. So anybody has a different view on IT? I mean, you know, I see a lot of polarized view
Sunil is
on
quite
IT.
bullish
Sunil,
on IT. You can.
Are you a contrarian on IT today?
Yeah, so you know, Mahalakshmi, I think obviously IT in India is very different from IT in NASDAQ. We are IT services. We are basically more like, you know, providing value services to the world. And if you actually see IT, except post-Lehman, when, you know, there was actually a degrowth, IT sector in India has never degrown in volume terms. You know, the growth rate might have varied anywhere between 7-8% to as high as 20%. But volume growth has always been between that. And I think now there is obviously this fear about degrowth. September numbers so far have been phenomenal. The order book has in fact gone up for IT companies. And this is in a quarter which was post the war and in a quarter where the fear of recession was the maximum. Again, this is a sector where India has global competitiveness. I think we are maybe the market leaders as far as the back office or the IT services is concerned. Companies overseas will, if they struggle, continue to outsource. And these are companies which are also going to benefit from the tailwind which the recent depreciation of rupee has provided. And the headwinds in terms of costs are behind us. And again, this is a sector which pays off almost 100% of what they make. And the cash flow is also 100%. So I think from here on, you know, if you're expecting the market to be like mid-teen kind of returns, I think this is a sector which should give you that. And we have also seen every 4-5 years something happens where this sector suddenly doubles in a year. So I think in a base case, on an annual basis, you make 14-15%, and then 1 year you hit a jackpot. That year you end up making 60-70% extra.
Okay. Are valuations really comforting in that space? Because even in, if you look at TCS or Infi, they'll all be upwards of 20 times, which of course in the context of several other stocks doesn't look as expensive. But if you're just looking at a 10% average growth.
Yeah, we have consumption stocks which grow at 10%, trading at 80-90p. No one questions the valuation of those companies. It's always the IT companies which will look at volume and everything else.
We question it all the time, Sunil.
Best in your discussion with Mahalakshmi.
Okay, fair enough. On the PSU pack, I mean, before we move to the next bet, one question on the PSU pack. Madhu, you've been very bullish on the PSU bank space. Are you really bullish on the entire bank space? You can clarify that. And secondly, that sort of, that PSU momentum got somewhat derailed except for a few, outperformers, and the disinvestment has somewhat softened. And do you see that picking up in the second part of the year? Will it become a bigger compulsion for the government to accelerate that, and therefore will that become a trigger for PSU stocks in the second half?
So first of all, let me say this: I have broken this myth in my own mind that this sector will do well or that sector will do well. Yes, we have to choose from within the sector, but I think we have to just buy the best company in the sector. Then only you make serious money, right?
But so best is difficult to understand.
No,
best is it cheap? Is it quality?
But this is your perception of, it doesn't come only, I hope it was as simple that you could put some number and arrive at a best idea. You will not have a panel of 6 people sitting here, right?
I won't have a job.
I feel so you have to just be able to buy the best possible company and hope that it really works. So you may choose from. So I was never bullish on the PSU banking as a whole sector. I was bullish on a few stocks, and by the grace of God, it has worked really well for me, right? So again, coming back the overall.
Is there still value?
I think so. I think so. You look at the results which have come. One result which came today is stunning. Absolutely. I would say there is still a steam, and this stock could still do well. The other point about which you make it, that disinvestment, I think you have to consider that 2024 is the election year. So I don't think any fire sale which will happen, maybe few pending cases may get resolved. But post 2024 is where I think there will be a lot of excitement if Modi ji comes back and there is a BJP stable government. Then you will see a real big drive towards disinvestment. But I am not particularly very excited that a lot will get disinvested in the next 18 months.
Fair enough. Prashant, your favorite hunting ground in the past, does it remain that way?
I think these stocks were mispriced, and as Manish was saying prior to this discussion, that what people don't like, often there is value, and you can see, this stock space has done quite well, because there are both good and bad PSUs and good and not so good private sector companies. So if you focus on good companies and good valuations, eventually returns come. And today, if you look at whether the banking space, the mining space, the power space, the defense space, these stocks have done extremely well. And I think there is still some value to my mind in the banking and the energy space.
Fair enough. Sunil, your bet for the year?
No, again, without getting into stocks, I think, we run a diversified fund, and predominantly, I would agree that sectors in India tend to be, predominantly financials, because it's 35-40% of the market as well as the economy. I am at least not underweight IT. We're not very overweight IT, but I continue to believe that this is a sector which has, very steady legs over a long period of time. I think pharma is turning out to be an exciting sector at this point of time. It might be slow to begin with, but companies again are clean. The 1.5 years of low growth because of non-COVID side of the business not doing that well, destocking, some headwinds because of supply chain issues, particularly raw material from China, are sort of getting behind us. So I think that is a sector where, at 15 to 20 times, these are good quality companies. So I would say that pharma over FMCG would be a preferred bet. And then, we are all looking at India growing at 6 to 8%. Banks have the ability to lend, which was not the case last 5 years. And therefore, anything to do with capex, I think should also pretty much do well. And finally, Samir mentioned the lower end of the consumption. I would agree that the tier 2, tier 3 side of the consumption, I think we have just started. So in the next 5-7 years, the aspiration of the mid-towns and the villages, and because of access to information, I think that side of the consumption, we are very positive.
So your top bet would be pharma?
No, I would not say it's a top bet, but it's a sector where we would like to go overweight. We are still not overweight. We have started nibbling, but that is one sector which can give you that alpha which you need at the portfolio level.
Fair enough. Devina?
Yeah, like Samir, we also have a diversified portfolio. So we always have a number of sectors, number of companies, because you don't know which ones will be the multi-baggers. So for the past 1 year, the sector we've been most overweight on, and which actually has given several multi-baggers, has been capital goods and industrial machinery. And that we went overweight last October, and we continue to be overweight. At the moment, it still looks good because it came out of a very, very long, beaten down phase, right, from 2009 for 12, 13 years. So we were sure it would give a big move, and there are fundamental changes also from PLI to government capex and so on. So, and that prolonged downturn meant the companies had become lean. So that still continues. Whether it will continue for the whole year, I don't know, because we always reevaluate everything every quarter. And we say that don't be a bear, don't be a bull, be a hare, because a hare moves fast and can change direction. But at the moment, that remains. IT we had liked a lot from 2020 onwards, where I had thought it was a very good switch from FMCG, which at that time was the hot sector.
Right.
Gave us great returns for the year and a half thereafter. Of course, this calendar year it didn't do so well. We would be about market weight there, no longer overweight. But I do think that there is no great negative also, because it is a dollar hedge, it is predictable, and the cost pressure when the startups were taking away people at high salaries is gone, because startups no longer have the money to do that. In textiles and chemicals, it is not a sector as a whole, because there are companies with very different dynamics within the sector. Chemicals, for example, if you look at commodity prices, there are companies where input prices have gone up and therefore margins will get squeezed, but there are companies where output prices have gone up, which are seeing a bonanza. So we've been picky, but those have also had opportunities. In the last 3 to 6 months, things we've added on have been a couple of FMCG names. Again, not everything across the board, and auto four-wheelers, auto components. So those would be things where we are somewhat overweight just now. So that would be it. Pharma has been a good space in a defensive sense, but it is not something where we expect great results when the market goes up.
So right
but
now
we are fairly diversified. And your finance, banks and financial services, we're not overweight, but in my mind, from where I usually am, this is not a sector that I ever like, because I'm always scared that the possibility of a negative surprise is always higher than that of a positive surprise. So till last year, we would have had negligible weight, considering this is such a large weight in the index, and which proved to be right, because 2020, that was the only sector that was negative. In 2021, it was not negative, but it went up only half as much as the market. So from there, we think like at least the better times ahead, because as interest rates go up, margins go up on the margin for banks, credit growth has picked up. So now we would be close to market weight in the banks, which is rare for us.
So capital goods continues to be your top weight right now?
Yes, right now it is the most overweight, at least in our portfolios. Also, another theme which our systems are throwing up quite clearly is that the small and mid caps are currently looking better than the large caps, though we always, in risk management sense, we cap our exposure to some of those, but definitely our systems are liking that space more.
Sure. So back to Sunil. Sunil, what's your view? I mean, do you think this year will belong to small and mid caps? Selectively, yes, because that.
So I think, if you again see over the last 25, 30 years, I think smaller companies obviously have an entrepreneurial tilt to it. And they tend to be more volatile, but ultimately they tend to be higher alpha generators. At the same time, Mahalakshmi, you can't classify them as one basket. I think to classify everything as mid cap and small cap is not right, because these tend to be very stock specific. And I think whether as a segment they do well or not, time and again we have seen that there are more than a handful of companies which offer you great potential to make outsized returns. The good thing about India is that we are a country driven by entrepreneurs. We have almost 1,500, 2,000 companies which are worth investing at different levels of market cap. And I think that provides us opportunity, also makes our job very interesting, So we are very hopeful that the way, things are sort of stabilizing in terms of at least the domestic side of the economy. And also the fact that most of these companies now are very prudent in terms of their financial leverage. So the shocks which used to be earlier there in smaller companies, I think they will have, they have reduced quite significantly. And this predictability is what leads to re-rating. So, we continue to be very, very optimistic on that space.
Fair enough. Prashant, your big bet for this year?
Mahalakshmi, as I said, I think the energy space and the banks, the large banks with a good liability franchise and a good digital platform, I think they continue to look good.
So I'll answer a little differently, apart from the sectors which we discussed. So Mahalakshmi, there is evidence to show two things, at least in the last 6 months. While the mid cap index and the small cap index have remained largely flat, even on a 6-month basis, there are more than 300 companies which have given more than 20% return in 3 months. And there are more than 200 companies, and this I am talking out of the top 1,000 companies. So we are not going to Bhangar cap, So we are saying, and there are more than 200 companies which have given more than 20% return in the last 6 months. So clearly, markets are telling us something, that some of these companies, as Sunil was saying, have really consolidated well. They've managed their balance sheets well. So we have to. If you have to really make money in India, that has been the story for last 25 years, right? You have to be able to go and pick the bottom-up stories really well.
Right.
So one differentiated sector which I like, which no one is talking about, is the infra companies, specifically the service side of the companies. They have consolidated quite a lot. It's been a 15-year period where there is no money which is being made. I think there is a competition intensity has gone down meaningfully well. There is a cousin of mine who lives in Raipur. He tells me that you get me bank guarantee and I will pay you 5%. So 5% only to get bank guarantee. So, and he is in the business for last 20 years. So obviously there is a premium to a good balance sheet. And these companies, I think, relative to what they were trading in the past and relative to their potential, and again assuming 24 is election, so there will be execution heavy years for the next 2 years, a lot of these companies. So this is one sector which could surprise on the upside in the next 24 months.
Sure. Manish?
So I'd like to say the following, that like I said in the beginning, the era of unidirectional bets is gone. There is no 30-year bull market in bonds and 30-year P expansion. Similarly, there is no sector which is going to beat, because in a slow growth world, it's someone who's gaining at someone else's expense, rather than a trend line which is carrying all the boats. Even if you see last year, like Prashant rightly pointed out, the stocks which were hated, PSUs, including Coal India, including the defense PSUs, HAL, BEL, ITC, which was anti-ESG theme. They are the ones which have done well. Even if I take auto, you would have lost money in Tata Motor and you would have made it in, surprise, surprise, TVS Motor.
Correct.
So I don't think this sectoral bet, and I'm not a professional money manager managing, and I don't need to buy 30, 40 stocks. You think like a business owner. There are businesses I like, the businesses I understand, but if I like the price, I buy them. If I reflect on where I am today, it looks like it's largely financials, but having said that, you could have been in Kotak and HDFC Bank and lost money over the last 3 years or been flat, and you would have bought the much hated at that time ICICI, Axis and SBI and made money. Maybe the time for, I think the HDFC Bank time is coming when MSCI has to get them out of the indices, and Nifty has to get them out because there's merger, there's uncertainty, will they be able to raise deposits? There could be money to be made in something such Main Street as something like that. The other thing worth reflecting, all these gentlemen and lady, they ran big mutual funds at some point. They are all sitting and running asset management businesses today. Is that not a sector worth betting on? It's a listed space. It's the biggest consumption item in India. More than toothpaste, you'll be eventually putting more money into
asset
funds.
Management companies.
Yeah, people they hate them because they think the bips are falling every year. Industry will fragment, it will become passive, it will become ETF. I don't think that's going to happen. If you're getting to $10 trillion GDP, do you think our asset management companies will remain so small? We look at Capital and Fidelity. Why would someone not emerge like that out of India? And that's the bet they are taking on their careers now. So we'll see at a price.
Anybody has a contrary
You
opinion?
get a price for businesses like this will be discarded, worth doing.
They are not small in market cap.
Yeah.
If you look at the market cap of HDFC mutual fund and compare it to market cap of Templeton and Alliance and all these who have 800 billion, 1 trillion more, the market caps of those per $1 billion of assets would be maybe 1/3 of what it is in it. So the company AUM might be smaller, but the market caps are not small.
Sure. We'll wait
So you
for
don't
the
like
price.
the valuation, essentially you don't like the
obviously.
valuation.
Everything at a price.
Yeah, because it's a tough business and now I am entering, so I like them even less.
Prashant,
And now
your-
Prashant is also not there.
I'm
And
saying-
now Prashant is also not there, so I can.
Fair enough. Thank you so much, gentlemen. Now we move to the most exciting round, which is the songs round, and I'm going to throw some names of stocks, and you have to suggest a song that befits the description of the stock or the performance of the stock this year or where they stand this year. Samir, HDFC Bank.
अरे दीवानो
the-
मुझे पहचानो कहाँ से आया मैं हूँ डॉन कहाँ से आया हूँ मैं
Fair enough. वो तो अभी याद ही दिलाना पड़ेगा. Okay, campus shoes.
So campus, I bought it in the after IPO that day, but it's not one of my top holdings. But that day I went on TV and said I bought it, and because I gave a few names. But anyway, my favorite Punjabi song right now is, but I don't know whether you guys understand Punjabi. Some of you do. Udi Mainu Kendi. Have you heard this song?
हाँ.
Udi Mainu Kendi, Jutta le de Sonia. हाँ सोनिए कैंपस ले सोनिए but it's not one of my top.
Fair enough.
But
Fair
I have
enough.
it. I have the stock as one of my 20 stocks. Yeah.
Fair enough. Lemon Tree, again for you.
No, I'm not. I don't know anymore. I just thought because you gave me 2 minutes notice.
Okay,
I
fair
have no
enough.
idea.
Mahalakshmi, you need to update your list.
अभी करना पड़ेगा.
No. Lemon Tree stock.
Lemon
I
Tree
have,
है
I don't
ना?
have a
He
song
has.
for it.
He doesn't have a song for
He
it.
will
He
not be
has.
Because he just gave me few minutes notice and said make some songs. HDFC तो दिमाग में आ गया फटाफट.
Fair enough. Canara Bank, Madhu.
So I think I'll sing only one song for all the companies which I like. So you can just
All
take
the
it.
companies,
all
ये क्या बात होगी?
Absolutely. So this describes. बड़े अच्छे लगते हैं ये धरती ये नदियाँ ये रहना और तुम.
Nice. So you like all stocks. ठीक है.
So all the stocks which I like.
Fair enough. Adani stocks, Madhu.
So I can remember one song which possibly can describe the Adani stock. Chag ghumya tere jaisa na koi.
For this year? For this year, for sure.
Absolutely.
Absolutely. Okay. Prashant, SBI. Before that, Coal India.
जिसका कोई नहीं उसका तो खुदा है यार. There are only two institutions which used to own Coal India, and you can see what has.
Well done.
Fair enough. ITC. Again, one of your favorite picks, and बाकी लोगों के पास नहीं था, आपके पास था.
जिसका मुझे था इंतजार वो घड़ी आ गई.
Absolutely. Yeah.
Cool.
Again, you can, this is what is surprising about stock markets. See, the price has a great influence on the way we think. Yeah, even people who have long years of experience in stock markets. What has changed in this company? Absolutely nothing. There has been no change. At least in banks, NPAs have gone down, and energy prices have gone up. But what has changed for this stock? Absolutely nothing.
Fair enough. HAL. Devina, you can also take this.
So maybe I'll pass this to Devina.
Devina.
देश को बनाना है मशीनों का नगर, वो गाना है ना, नन्ना मुन्ना राही हूँ देश का सिपाही हूँ, चलो मेरे संग, बोलो मेरे संग जय हिंद जय हिंद. It's part of that. आगे बढ़ाए जा कदम.
Okay, cool. Tata Motors.
For whom? Not for me, I suppose.
Anybody?
On a lighter note, you can do it. Of course, greatest company, but the song which may match the most is "मेरा जूता है जापानी, ये पतलून इंग्लिस्तानी, सर पे लाल टोपी रूसी, फिर भी दिल है हिंदुस्तानी."
Fair enough. Very well said. Manish, IT stocks for you in fee.
IT stocks is the sector which has saved our country. So like तुमको देखा तो ये ख्याल आया, जिंदगी धूप तुम घना छाया. Protecting our nation. Where would we be without IT sector?
Fair enough.
Yeah, good one.
Hats off to them.
Good one. Z.
Okay.
Manish.
हम होंगे कामयाब एक दिन, I guess.
Devina, Tata Elxsi.
उतना ही उपकार समझ कोई जितना साथ निभा दे, जन्म मरण का साथ, ये सपना बिसरा दे. It's been a great performer for us, but I think for now the run is over.
Correct. Iron Exchange, Sunil.
It's a small cap, but I think with this Jal Nigam and all this, her Nal mein Jal, you can say tip tip barsa pani, opportunity ne aag lagai.
Fair enough. Thank you so much, gentlemen, and Devina, thank you so much. It was wonderful talking to you people as always, and wish all of you a very happy Diwali, and of course our viewers also a very, very happy Diwali. Thank you so much.